At its peak, this company was worth billions. Investors trusted it, employees believed in it. From the outside, everything looked stable. And then, almost overnight, it collapsed. Not because of one dramatic mistake, but because of a series of quiet decisions no one was paying attention to. When companies fail, people often look for a single moment: a bad CEO, a scandal, a market crash. But most collapses don't work like that. They happen slowly, while everything still looks successful. Revenue grows, expansion continues, headlines stay optimistic, and beneath the numbers, risk quietly accumulates. In its early years, this company did almost everything right. It moved fast, it identified a real opportunity, and it scaled aggressively. Investors saw momentum, customers saw innovation. Inside the company, teams were rewarded for growth. Faster expansion meant bigger budgets, bigger numbers meant more confidence, and confidence became the company's most valuable asset. But confidence can be dangerous, especially when it goes unquestioned. As the company grew, something subtle changed. Decisions stopped being about stability and started being about speed. Teams were no longer rewarded for reducing risk. They were rewarded for increasing output. Short-term wins became more visible than long-term consequences. And slowly, the system began to favor one thing above everything else: growth, at any cost. No single decision was reckless. Each one made sense on its own, but together they created a fragile structure, one that looked strong, but depended entirely on everything continuing to go right. The first warning signs weren't dramatic. Margins tightened. Internal reports became more optimistic than accurate. Questions were delayed, not answered. The company was still growing, but it was becoming increasingly sensitive to disruption. One delay, one missed projection, one shift in market conditions, and when pressure finally arrived, the system had no room to absorb it. When the collapse came, it felt sudden. Valuations dropped. Confidence evaporated. What looked like a strong business was revealed to be tightly balanced, with no margin for error. By the time the problems were visible from the outside, it was already too late to fix them. The collapse wasn't caused by panic. Panic was simply the final symptom. This wasn't a failure of intelligence, it was a failure of structure. The company didn't collapse because people were careless. It collapsed because incentives rewarded speed over resilience. Systems matter more than individuals, and when systems quietly encourage risk, collapse becomes a matter of timing, not possibility. Stories like this are easy to dismiss as rare. They aren't. They're happening quietly all the time, beneath the numbers. This is the deep capital.